All right, good morning. So big announcement today. We knew this was coming. I haven't made any videos this week. We kind of knew what was going to happen here, but there's a few things that are sort of unexpected. We know that this particular Fed was dovish, meaning that they were, going to be helpful for stocks. The question is, when the Fed says things like they said today, how does that affect mortgage rates? How does that affect real estate? How does that affect the stock market? Let's take a look. All right, I'm going to dive in here. So basically, Powell comes out and announces they're meeting in Jackson Hole right now, which, by the way, I've been to the place where they meet in Jackson Hole. It is awesome. Absolutely awesome. Jackson Hole is one of those places you just have to go if you ever want to chill or ski. But so Powell makes the announcement. The Fed has gotten together. They have collectively agreed they're going to do some things differently than before. And the thing that's huge about this is that they aren't just saying, hey, for right now, we're going to do things this way. They're actually saying, you know what, our entire outlook, the way that we as the Federal Reserve are going to look at our job here. And remember, they are essentially government employees, but they are not elected, right? They're not elected by the people, but they have the ability to enact economic policy, huge economic policy. So they have a lot of power, and that's why this is so important to understand. So they make the announcement that, hey, we're going to change the way that we look at things completely. So he announced this, what they're calling a policy shift, meaning that they're changing the way that they're going about stuff. So it means the central bank will be more inclined to allow inflation to run higher than the standard 2% target. So in the past, if inflation got to that 2% target, the Fed would start raising rates. Even if it got close, they would start raising rates to head it off because they really didn't want to get above that 2%. The Fed was, it has been there to sort of protect from inflation. The whole concept of buying a loaf of bread with a wheelbarrow full of cash. They wanted to prevent that. That's why they were created. That's what they're there to do. But in recent times, it seems as though they're there to really just help investors and help make sure that growth continues. And you remember, probably don't remember, but I don't know, 6 or 8 months ago, this is what I was saying. The Fed seems to be doing things differently than what they're supposed to. They seem to be protecting the growth curve versus trying to protect the inflation curve. Now they've actually changed their policy completely to be more on the side of what I was saying before, more on the growth curve, protecting the growth curve and not the inflation curve. What they're doing here specifically with this is instead of waiting for it to get to 2% and then pulling out the guns, they're going to allow for an average of 2%. So what this means is that if we see inflation at 1%, and they're just making a random example for the sake of easy math, let's say inflation is at 1% for 2 years. The Fed is now going to be okay with inflation going up to 3% for the following 2 years, or for 2 years to balance it out. So they're okay with an average, a running average of 2%, and not a max ceiling of 2%. Which means that the Fed, who's always been there to protect from inflation, is now saying, you know what, we're going to actually pull the governor back a little bit on where we're capping this. We're going to raise the roof, if you will, on what we're going to allow. That seems like a weird moment to do that, considering that everything that's going on with the economy and unemployment and so forth, to say that, hey, we're going to raise the roof. But there's a couple of things. We've noticed that the stock market has been unstoppable. The stock market has been unstoppable, and this is where the whole Wall Street investment mentality really comes in. Has the stock market been running up uncontrollably because Wall Street already knew this was coming? Remember, on Wall Street, it's buy the rumor, sell the news. I'm actually very curious to see how the market does today, particularly tomorrow on Friday. You would think with this type of rhetoric coming from the Federal Reserve, you would think that stocks would now go just absolutely nuts. They've said, I'll show you more of what he said here. And this is, and Chairman Powell actually said this himself. He called it a robust updating. A robust updating of Fed policy. Robust indeed, sir. Holy smokes. The central bank formally agreed to a policy of average inflation targeting, and that's what I was just explaining. That means that it will allow inflation to run moderately above the Fed's 2% goal. So they're not going to let it go to 10% or something like that, but they're going to allow it for some time to go above that, following periods when it's been below that, so that they can have more of an average 2%, not a ceiling of 2%. So these changes were essentially formalized in 2012, but now this, based on the longer run goals and monetary policy strategy, which was a statement that was given back in 2012, the approach to interest rates and general economic growth is basically now more tilted towards the general economic growth. So if you look at what some of the things said, and this is one of the things Powell said here, he said, many find it counterintuitive that the Fed would want to push up inflation. However, inflation that is persistently too low can pose serious risks to the economy. So this is a really big statement. The chairman of the Federal Reserve, who's speaking on behalf of the board, has said that inflation that is persistently too low can pose serious risks to the economy. Holy smokes. Talk about a mindset shift here. I mean, we've known that they've been pro-growth for a while, and I've been hinting at this for months and months and months. We know, that the Fed is independent of the administration, but the administration does have influence, for sure. Does have influence, although can't really dictate anything, does have influence. And what we're now seeing here is, basically we've got a Fed that says, listen, we're going to keep interest rates low. We're going to keep them low, not just until we get back to that 2% target, but we're going to keep them low even past that. So in other words, we're going to keep interest rates low forever, ever. Who knows when rates would ever go back up? Now, do people want rates to go up? Some people do. Some people don't like the idea that you get 0.1% for your savings account, or that you can't get a money market or a CD for a year that pays even 0.25%. Some people don't like that. Some people want the safe investment, which you're not going to get here. Now you have to buy mortgage bonds, so it should be good if you want safe investments to go to something like mortgage bonds. But in the short term, this is causing problems. Actually, let me tell you one more thing that he said. The situation, Powell said, can lead to an unwelcome fall in longer-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. Interesting way to look at it. We're now talking about... oh, sorry, I didn't have that on the screen. He said it right here. That's what I just read right there. He also... he said some other things, but basically, right now, we're in a situation where unemployment is high, and the chances of seeing, this significant inflation anytime soon are pretty slim. However, it depends on how you measure that. Because if we just go and look at what's going on in the stock market is flying high. In fact, all Dow erases losses of 2020. So all the amount that we were down for coronavirus, all that is all gone. And NASDAQ's way higher. S&P, I'm not exactly sure, but I would check on that. It's really close if it's not there yet. But the Dow's erased all of its losses. The S&P's been doing better than the Dow. The NASDAQ's been doing better than both of them. So now all of the coronavirus losses have been erased from the stock market, but they haven't been erased from the job market. So there's something's wrong. Now, this is what I mean by we got to be careful, because a lot of people will see this news and they'll say, all right, well, this means game on, stocks, higher. It could be true. It could be true. That's what it would seem like. But remember how Wall Street works. This whole time we've been wondering, sitting here going, how could stocks continue to go higher given the scenario that we're in? Every day, just relentlessly, the stock market does not want to go down. This very well could be your answer. Wall Street may have known about this for months and months and months, that this has been building up, because the Federal Reserve does not decide these things overnight. And make no mistake, there are people who have connections to Wall Street that are in touch with the Federal Reserve Board. There's no doubt about it. So if there was a hint that this was coming, that the Federal Reserve was going to completely change their mindset, completely change what they believe their job is, it makes sense now. But remember, the way that Wall Street works, buy the rumor, sell the news. So the question is, will this hold? Right now we're up 250 in the Dow. If we close lower than that, that would be a sign to me. We'll see if tomorrow's action is weak as well. It might be over. Because now that this is in play, now that this is known in the market, this is usually where the pros sell their shares to the suckers. So just be careful. Be careful here where all these losses have been erased. in 2020. All the losses have been erased. That'd be a good time to get out if you knew about this ahead of time and you've been buying the whole way. That'd be a great time to get out. So be very, very careful here. Let's see what this has done to mortgage rates. And this is the problem here. As you can see, we're, oops, got to show your screen, Derek. So we're down 16 basis points today. So this hurt us today. This sucks. I'm going to show you a little bit more. We're going to get zoomed in here and really dialed in, because ultimately what's happening right now is super crucial, not just to real estate, but in my opinion, to where we head economically. This will just show you right here. Okay, so remember, higher prices, so the higher these candlesticks go, the lower interest rates go. So what we want is we want higher prices on bonds. This is the day that rates went up, right? Bond prices went down, rates went up that day. This is a bad day. We were in great shape. We were up here at all-time highs, like just loving life, locking crazy rates. And then, boom, that happened. A lot of things were cause of that, but mostly this was the FHFA's penalty that came in and just sort of spooked everybody. So, and this happened before the announcement was made, but again, Wall Street knows these things before they show up on the charts. So just know that this was probably the reason. Had a decent candle after that, which made us look like we might go higher, and we ultimately did. But that rolled over as well. And unfortunately, this was the key day. And we got a lock alert here. You can see this is all provided by MBS Highway. Barry Beebe, it's amazing. He gives this to us and allows us to share this with you. So, you know, this was a day that we were told to lock. We definitely locked some loans that day. There's no doubt about it. But as you can see, we fell below this moving average right here, which was hopefully going to be our catapult higher back to those highs. We got beneath it. Now it's showing up as resistance. So today, and I'm going to try, I don't know if I can zoom in further. Yeah, it's going to screw my thing up. That's okay. Let's clear it. This right here, this is today. So this could change. This is early in the morning. I know I don't normally make videos this early in the morning, but this is so dramatic, and this is going to be such a huge couple of days between today and tomorrow to really dictate what's going to happen next here. And so here's what's going on. You see, we've got this is a huge range. Look how small these other candles are. I mean, all these candles, except for these days where there's big things going on. And here we have another one of those today. Now, what's significant about this is that we've touched both the support and the resistance line today. So we've actually ping-ponged back and forth here. And what happens when you get these support and resistance levels really close to one another is that usually it's a breakout one way or the other. So whenever this thing gets outside of this range, typically, you know, it'll break out and go that way that it's continuing to go. So if we get above this thing and we can close above it, then typically we're going to run higher. This will become support. We'll bounce off that, and the opposite will happen down here. So this is a huge day, a huge couple of days to see what happens with mortgage bonds. Because remember, if it's the case that stocks are going to be on fire, if it's the case that, hey, why invest and make 2% a year in mortgage bonds when, look, we're making 1% a day in stocks? It's keeping money out of the bond market. Now, the Fed is buying bonds. They are actually the ones that caused this. They're the ones who've saved us, too. So we have to keep that in mind. And they're the ones who could save us again. We need them to be in and buying mortgage bonds if they're going to do this in order to keep rates low. Otherwise, you know, if this breaks lower, if I zoom the chart out, or actually if I just show you this again, as you can see, this is all good stuff right here. Everything here, these are all great days. Great days to lock your rate if you're buying a home. Great days to lock your rate if you're refinancing a home. But you can see once we break beneath this, it's just, there's nothing there. I mean, we don't have support for a long ways. You know, so it would be pretty cataclysmic for that to happen. Although we do have the Fed on our side, so they could step in at any point and drop 20 or 30 billion on this thing and change everything. They could easily do that. But remember, the last time they did that, they blew out the hedge of the banks. Ended up causing major problems and causing rates to actually go higher when they were trying to make them go lower. So they don't know necessarily everything. They aren't perfect. They have a lot of bullets. They have infinite bullets, but they aren't necessarily always perfect. So we can't just count on the Fed. What I'm telling you here is that this is a pivotal couple of days. And I'll be keeping you posted on what's going on. You're going to see a lot more content from me as well in the coming days from a real estate perspective. We'll be doing the real estate debate every other week here coming up soon. And we're going to be talking about the hottest topics in San Diego real estate. We're going to talk about how these things, these macro implications, are going to affect things. Derrick Evans, NMLS 155010, VA Home Loan Specialist. If you have questions about the VA Home Loan benefit, call me, text me. If you want to know if it's a good time to refinance, I can absolutely help you figure that out. Run the numbers, make sure everything makes sense before you do anything, like pull your credit or whatever. So here's the deal. The next couple of days, we got a lot of big things coming. We're going to find out what the trajectory is going to be from this massive policy shift. And hopefully, I'm optimistic that it's going to work out, that these guys know what they're doing, that ultimately we'll be okay. But be careful. Be careful of the Wall Streeters, because they've clearly known about this for months. And they've run this market all the way back up to where we're not even down anymore for the year after coronavirus, record unemployment stuff, and all that. So that may be a little overcooked. So be careful out there with your stocks. And a lot of people would ask me about stocks, a lot of people buying stocks. Be careful about buying too much in the stock market right now. All right, guys, that's it. I got to get back to work. There's a lot to do today. Share this video if you want to make your friends smarter than everyone else. I'll see you soon.